Here's an example of a 50-year-old male preferred non-smoker. And I'm gonna walk everyone through what the difference is between the traditional self-pays of term insurance and then self-pay of index universal life, whole life, variable life. And then we're going to transition to the power of properly applied leverage using premium financing from institutional sources like banks and things like that to finance the premiums, both for a death benefit only play as well as from an income only play. And hopefully, if this resonates with you, reach back out to us. Let's set up a time to talk about your particular situation and get this customized for your portfolio so that we can see where this fits in and we can structure it within suitability and affordability guidelines. So from a term insurance perspective, for a 50-year-old preferred non-smoker, if we're going to do a 10-year term right now, one of the cheaper products out there is just under $10,000 a year for $10 million of life insurance coverage for 10 years. And then a 20-year is about $17,000, almost $18,000 a year. And a 30-year term insurance policy is about $32,000 a year. Now, there's statistics out there that say less than 2% of all term insurance policies ever written since the inception of life insurance have ever paid death claims. That means 98% of all term insurance policies either expire at the end of a 10, 20, or 30-year term, or the insured or the policy owner stops making the payments and the policy lapses. Thus, the 98% of all premiums that are paid on term insurance policies is a straight cash rake for life insurance carriers. So that's where permanent policies come into play. Permanent policies can take the form of index universal life, whole life, or variable life. And there's self-pay premiums that it can be structured in a various number of ways. We can do a premium to minimally fund it. We can do premiums to maximum fund it. What we're trying to do here is line up the projected death benefit with the premium duration of our premium financed scenario. Since we're only going to show 10 years of payments or potential payments on the premium finance scenario, we're going to apply the same 10 years. So to maintain a $10 million death benefit in an index universal life policy, when we searched the market, this particular carrier had the relatively less expensive annual premium for 10 years of $155,000 a year for 10 years. I just did a video on this on the YouTube channel, which talks about the arbitrages. It should be published here shortly, but one of the arbitrages of premium finance is this $155,000 premium payment. You have to earn a pre-tax equivalent of, call it, $270,000 to $300,000 to pay the federal, state taxes, depending on where you live, to net out $155,000 just to pay the premium. Right? When we finance the premiums, that doesn't have to happen. It's something to keep in mind. But $155,000 a year for 10 years, death benefit at age 90 is $10 million. That's a 5.3 IRR on your money. From a whole life perspective, what many would consider the most conservative, traditional component of permanent life insurance, yeah, it is, but they also require you to pay a lot more. $536,000 a year for 10 years. Now, granted, the death benefit grows to $26 million, but $536,000 for 10 years is $5.3 million of total premium payments. That's only a 4.5% IRR. $155,000 payment from the IUL policy is a 5.3% IRR. And then we've got variable life. Variable life is variable life doesn't have the guarantees that index universal life or whole life has. But in this example, it could work, right? But it's requiring $163,000 a year to maintain a death benefit at age 90 of $10 million. That's a 5.2% IRR. Now, when we come over here to the premium finance world, the IRRs that we're generating are 9.5% on our structures. That's because we're proposing, in some of them, a $75,000 a year payment for 10 years. Now, that is half of what the index universal life requirement is, which it makes sense, right? But the death benefit, we can get that up to $19 million, and it still has a 9.5% IRR. The question is, what's the trade-off, right? And so when we talk about premium financing, and we did a video on this not too long ago, there's some considerations. We got to think about interest rate risk. We have to think about performance risk of the policy. What's the exit strategy going to be, if any? And then what's the collateral exposure that we have, right? And so here is paying $75,000 a year in column 12. This 50-year-old gentleman, preferred non-tobacco, $75,000 a year from a $10 million policy. The projected peak collateral, additional gap collateral required, hits about, just shy of $500,000 and starts coming down. And we're going to exit the loan in this example in year 20, which means we're taking the bank out. And so this individual has a $14 million death benefit and growing. And so $75,000 a year for 10 years is $750,000. If he died at age 80, it's a 10.9% IRR, an $11 million income tax-free death benefit paid to beneficiaries. Now, look at column 12, $75,000 a year. This particular carrier does not require loan or interest payments to be made. So if you wanted to fully defer, capitalize those interest payments back into the loan, then the projected collateral hits a peak of about $975,000. But remember, that's just a pledge of collateral, not a fee, not a payment, not a cash flow number. In fact, cash flow is zero. This is not free, it's financed, 100% financed policy. And then we have an exit in year 15, and we have in the same year 80, a $14 million death benefit, and the client paid $0 out of pocket. We cannot calculate an IRR on that number because the client didn't pay anything out of pocket. Yes, the client pledges collateral, but it's not paying anything out of pocket. That's the death benefit only design. If I transition now to, a what's in it for me design from the insured's perspective, then we want to look at what the potential tax-free distributions could be. So back to $75,000 a year for 10 years. We know that the peak is $496,000 that we talked about. We know that we're going to exit the loan in year 20 in this example. But instead of it just building up a death benefit only design, we went and we solved for what could be the potential tax-free distributions that you could take out or the client could take out every year, income tax-free, with these assumptions. And $274,000 a year, income tax-free. Now think about it, $75,000 a year payment for 10 years, let it cook for another period of time, start to take distributions of $274,000 a year, income tax-free, while maintaining a death benefit over here for beneficiaries. It is a pretty attractive design, and that $274,000 doesn't stop, it keeps going. So something to think about. And then lastly, to compare it to the no out-of-pocket, no interest payment, pledging of collateral, we know that it gets up to a $974,000 projected peak collateral amount. We know that we're exiting the loan, but the distribution is $131,000 a year, income tax-free for something that the client did not pay any interest out of pocket for. We financed it entirely, 100% of the way, not free, it's financed. The client pledged the collateral as it was needed to be pledged. The loan got paid off when it needed to get paid off, and $131,000 a year income tax-free. That's the equivalent of about $250,000 to $60,000 a year pre-tax, and still have, depending on when death would occur, anywhere between a $5 to $12 million income tax-free death benefit. I hope this has been helpful for you. This is the power of putting properly applied leverage into a premium finance life insurance structure. It's not for everybody, but it is for a lot of people where it makes sense. Hope this is helpful. Let's set up a Zoom meeting to discuss your situation specifically.